You've heard of insurance being bundled with mortgages. Now, the question that I'm asking today is this a regulatory requirement or is this more of a suggestion that it's good financial planning to have a life insurance cover when you are getting a large home loan? That's the question that I'm asking. I'm also asking the difference between a pure term cover and what is called a home loan insurance policy. Joining me to talk about this is Vivek Jain, the CBO of Life Insurance at Policybazaar. Vivek, thanks so much for taking the time. Let's start with that.
Hi, Alex.
Pleasure. Is this a regulatory requirement or is it often sold together to a mortgage taker?
So, Alex, it is not a regulatory requirement to take bundled a cover along with a mortgage, but it is obviously advised to always cover your liabilities with a term insurance plan, so that in case of any mishappening to the earning member of the family, the asset is kind of protected and the outstanding loan or the liability can actually be paid off through the term insurance cover.
Okay, so well answered. And so therefore, obviously, it's important to have this term insurance because you don't want to lose the asset. In this case, you don't want to lose the house, right? Because the house ultimately is the collateral that is given for mortgage and for loans of that sort. So let's talk about this because there is a home loan insurance and there is a term insurance. What is the difference between the two?
Home loan insurance, or actually credit life as it is popularly known, a lot of times customers end up buying a bundled product along with the loan that they are buying, right? Which is typically a group term insurance plan, and you kind of say for a 1 crore kind of a loan, you end up paying anything where between 3 to 4 lakhs additional for that insurance, and that kind of gets added to your home loan. Versus buying a term insurance, you have the flexibility of buying from different companies, and it is far more cheaper because it is a retail plan, so it doesn't attract any GST. So there is a clear difference of about 18%. Plus, you can pay in a monthly mode fashion, and and keep it till whenever your loan actually lasts.
Interesting. So what you're saying is that instead of buying it, and this is kind of like a motor insurance as well, right? Kind of, not exactly. But if you go to a dealership and you buy a policy when you're buying a car, you will often be priced higher than if you bought that same policy online. And a lot of people don't know that they can actually do that as well. They don't necessarily have to buy the policy at the dealership. So this is kind of like that. You don't have to take the policy, the life insurance policy, the term insurance policy at the bank where you're getting the loan from. You can actually buy it online. You get a much better deal. Is that how it works?
Absolutely, absolutely. I think you're bang on. So I'll just explain it with the example I was referring to. See, say you are a 30-year-old and you take a home loan of say 1 crore, right? If you take a bundled credit life plan, there you will end up basically paying 3 to 4 lakhs, anywhere between 3 to 4%, which is about 3 to 4 lakhs getting added to your home loan account, and you will basically, that will translate at a 8% interest rate. I'm just taking an example, translate into about 2200 to 2500 of monthly premium. Whereas if you take the same plan, a same term insurance plan with a reducing cover, that would cost you about 700 to 800 rupees monthly. So there is a clear difference of almost 2 to 3 times when you buy it online or separately versus buying it as a bundled product.
Okay,
And,
good.
and added to that, you have the flexibility of choosing the insurance company that you want, choosing the pay term or policy term you want. You have a lot more flexibility versus when you're buying it as a bundled product. you may actually not get options and you may have to end up buying one product that is available with that.
Okay, good point. Vivek, just a last point that I want to raise with you, which is that in an ordinary case, right, if hypothetically I were to go out as a 30-something-year-old and buy a property, and I already have a term policy, and it is robust enough, then there is no need for me to go out and buy an additional term policy. Is that fair?
So yeah, if you have a very, very good life cover, right, typically in the range of 10 to 15 times of your annual income, then you are broadly covered financially in case of any mishappening. So then you can avoid taking this, but I would still recommend, because it is fairly cheap and you can actually see, supposing you're taking the loan for 20 years, but you end up closing it earlier in 7 to 8 years, you can actually stop paying for that term insurance, right? So in a way, you can maybe, because it is an added liability over and above your other expenses. See, finally, term insurance is is income replacement, right? The term insurance that you would have bought would be to replace your income in case something happens to you. Given this is an additional responsibility, you can take a add-on cover, but you're right, if you think that you are sufficiently covered already, you can skip it altogether.
Got it. All right. All right. On that note, Vivek, thanks so much for taking the time. Pleasure speaking with you.
Thank you so much, Alex.